Running a charity is hard enough. You are managing fundraising, compliance, and growing demand, all while trying to stay financially stable. But here is the question no one is asking. Should your charity have a trading subsidiary? It is one of the most overlooked strategies in a charity's financial management, which can unlock new income streams, manage risks, and even save on tax. In this video, I am going to walk you through what a trading subsidiary is, when and why your charity should consider one, and the exact steps to get started without the legal headaches. Let's get into it. So first things first, what exactly is a trading subsidiary? It is a separate limited company, usually wholly owned by your charity, set up to carry out non-charitable trading. Think of it like a business that your charity controls, but one that sits legally apart from your core activities. Why do this? Because not all trading is allowed inside a charity. For example, selling merchandise to the general public, running a cafe open to everyone, or offering consultancy or training to organizations outside your beneficiaries. These are all commercial activities. If your charity does too much of this directly, it could risk its tax status or even breach charity law. A trading subsidiary protects you from that risk while still allowing your charity to benefit from the profits. Not every charity needs a trading subsidiary, and many never do. But here is when you should seriously consider one. First, when your trading activity is not linked to your core mission. Remember, trading that directly supports your charitable activities, like a school selling textbooks to students, is always tax-free regardless of amount. I am talking here about commercial activities outside your main charitable purpose. This is called non-primary purpose trading, and it can lead to tax if done inside the charity. Second, when your trading income is growing. There is something called the small trading exemption, between £8,000 and £80,000, depending on your total income. If you go over that, you are in taxable territory. Third, when you want to manage risk. If your trading venture flops, you don't want it to pull down your whole charity. Fourth, when transparency is important. A separate entity with its own accounts can make reporting better and professional. Here is the simplified structure. The charity sets up a limited company, typically a company limited by shares. The charity owns all the shares, so it controls the business. The subsidiary can trade, earn profit, and pay tax like any other business. However, here is the trick. It can donate its profits back to the parent charity using gift aid. But timing matters here. The subsidiary must make these gift aid donations within 9 months of the end of its accounting period to get the tax relief. This often reduces the subsidiary's tax bill to zero and the charity gets tax-free income. Important safeguards: the subsidiary must have its own directors, bank account, and accounts. If the two organizations share staff, space, or systems, everything must be done at market rates. Trustees must ensure that the charity's interests always come first, not the business. If you are wondering whether a trading subsidiary is right for your charity, book your call at evolvecatalyst.org. We will help you figure out the right structure and avoid common legal and financial mistakes. Many large charities run retail operations through trading subsidiaries. They manage their high street shops, selling donated and new goods. This keeps the commercial risk separate from charitable funds, while profits can be donated back to support the charity's work. Let me look at two examples. Let's say a children's charity sells branded t-shirts and hosts fundraising events. Rather than do this inside the charity, which could fall outside their charitable objects, they set up a trading company, limited or LTD. It handles the trading, keeps separate books, and donates profits each year. Another example is a cafe or venue. A community center runs a cafe that's open to the public. This is not direct or directly charitable, so they form a trading subsidiary to run the cafe while keeping charitable funds ring-fenced. These examples show the flexibility of the model from major charities to local ones. Before I talk about how to set up a trading subsidiary, let me be honest. This structure is not magic, but it does offer real value. Top benefits: protects your charity from commercial losses, expands your income through trading you couldn't otherwise do, maximize profits using gift aid donations from the subsidiary, and allows for sponsorships or partnerships that may fall outside your charitable scope. Key risks: extra admin, 2 sets of accounts, boards, and reporting. Less tax relief: the subsidiary pays tax like any business unless profits are donated. Risk of confusion: if not managed well, it can blur lines and concern auditors. And if the subsidiary fails, your charity should not bail it out, or trustees could face serious action. So it is useful, however, only if done properly. Now let me talk about how to set up as a trading subsidiary. If you are ready to take action, here is a roadmap. Number 1, check your governing document. Make sure it allows you to set up a subsidiary. Step number 2, register a company. Usually a company limited by shares, wholly owned by the charity. Number 3, appoint directors. They can include trustees. However, you must manage conflicts of interest carefully. Number 4, set up a board agreement. Cover decision making, reporting, and how profits will be donated. Number 5, document any shared resources. If you share office space or staff, record the fair market value and charge accordingly. Number 6, open a separate bank account. No share finances. Keep everything separated. Number 7, plan your gift aid strategy. Work with an accountant to ensure gift aid donations are legal, timely, and well documented. Remember that 9-month deadline I mentioned earlier. This is crucial for your tax planning. Before I finish this video, let me share some tips for you as a charity leader. Don't create a subsidiary for just a bit of trading. The admin probably is not worth it. Review performance annually. If it is not delivering, you can otherwise shut it down. Budget for working capital. Don't give 100% of profits to the charity if the business needs cash to operate. Don't forget about beneficiary operated trading. If your charity's beneficiaries do the most of the work, those profits can be tax exempt too, even if it is not primarily purpose trading. Always consider VAT. Subsidiaries are treated as regular businesses, so you may need to register. If this sounds like a good opportunity for your charity, however, you are not sure where to start, book your call at evolvecatalyst.org. We will help you assess whether a trading subsidiary is the right fit and guide you through the process step by step. So over to you. Is your charity thinking about setting up a trading subsidiary? What's your biggest concern, risk, cost, or complexity? Let's know in the comments below. And if you found this video helpful, hit subscribe and share it with another charity or trustee who could benefit from it. Thank you for watching, and I will see you in the next video.